In IGCSE business studies, you may have to calculate liquidity ratios from information you find on the balance sheet and on the profit and loss account. These liquidity ratios, and there are three of them, the current ratio, the acid test ratio, and the stock turnover ratio, these three liquidity ratios do not judge performance in the past. They ask how well set up, how financially healthy is a business looking forward, looking into the future. So the first ratio is the current ratio. And the current ratio, sometimes called the simple ratio, is calculated with this equation. Current assets divided by current liabilities. This tells the business whether it will be able to pay the bills it has to pay in the next 12 months, its current liabilities, with its near money assets, the current assets, which of course are made up of cash, stock, waiting to be sold, and debtors, that's other businesses who owe this business money and will pay them soon. So as long as the top line is bigger than the bottom line, as long as the near money assets is more than the bills they have to pay, this will calculate to a number bigger than 1. Ideally, it should be 1.5 or even up to 2. It shouldn't be any bigger than that. That would imply that the business is holding too much of its assets as money. But it dare not be too low, and certainly not below 1, because that would mean they can't pay their liabilities with their assets. They would probably have to sell a fixed asset. So that's useful because it informs the business whether they are about to encounter a cash flow problem. Now the second liquidity ratio is the acid test ratio, and it is an adaptation or a variation of this one. So let's write up the acid test ratio. Acid test ratio is the same equation, but it's current assets minus stock. Current assets minus stock, because they may not be able to sell their stock as and when exactly they want to sell it. So the stock may not easily be turned into cash. Consequently, we're asking the same question. Can the liabilities be paid with the remaining current assets? That's cash they already have and debtors. Again, this must calculate to above 1, and ideally about 1.5. Perhaps 1.5 is a good value for the acid test ratio and implies that they will not have a cash flow problem in the near future. Finally, businesses will calculate their stock turnover ratio. This is calculated with the following equation. Cost of sales, which we find on the profit and loss account, divided by stock, which is found on the balance sheet under current assets. So cost of sales divided by stock. This will generate a number. Let's say that number comes out to 15. What does that mean? Well, the stock turnover ratio tells us how many times during 1 year the business entirely sells and replaces its stock. So this business, which has a stock turnover ratio of 15, it means that they have sold and replaced their stock 15 times in a single year. We can't say if 15 is good or bad, it depends on the business. Someone selling tomatoes in a market hopes to sell and replace their stock every day. So they would expect a stock turnover ratio perhaps 365 if they went to the market every day. Whereas, let's say, a supermarket cannot hope to sell everything it has and then replace it every day. So consequently, different kinds of businesses have different expectations for stock turnover ratio. But any business will compare its stock turnover ratio for this year with last year and hope that it's higher. They hope that they are selling off and replacing their stock more quickly. That would be efficient business. So these three ratios are the liquidity ratios, and it's very likely on the GCSE Business Studies exam you'll be given some information, perhaps not the whole balance sheet or profit and loss account, but calculating these Very useful, not for judging past performance, but for saying, is the business well set up for the future? Thank you.